Overhead expenses. Previous chapters examined direct costs, which vary with sales, but overhead expenses tend to remain fairly constant in spite of changes in your sales volume. Every builder has overhead expense. In this chapter, we'll take a detailed look at the overhead expense categories you should include in the general ledger. We'll also explain the difference between variable and fixed overhead expenses. Budgets serve as a measure against which you operate. Without budgets, your company doesn't have a financial roadmap. Many builders ignore the importance of general expense budgets. You probably think general expenses are uncontrollable. This chapter will show you how to control what may appear to be inevitable. In truth, most expenses can be controlled within a reasonable budget. The control you exercise is a measure of your effectiveness as the manager of your business. A variable and fixed overhead. Earlier in this book, I explained the distinction between selling expense and fixed overhead. Selling expenses usually vary with sales. Your fixed overhead are fairly uniform whether sales go up or down. The difference between direct costs and overhead expenses is that direct costs are identified with the project. Variable overhead expenses are not associated with any single job, though they vary with sales volume. For example, there's a difference between labor and union welfare expense. The labor that goes into a project is a necessary part of the production process. It generates income. The union welfare paid on that labor is once removed from the generation of income. It doesn't produce sales, yet it's a necessary expense of doing business. It's variable because the expense varies according to the cost of producing that income with labor. Overhead expenses such as office rent are fixed. No, variable expenses, payroll taxes, other federal excise tax licenses, permits, and fees, public utilities fees, state fuel tax, state income tax, automotive, repairs and maintenance, automotive gas and oil operating supplies, small tools, equipment rental, union welfare, insurance collection expenses, bad debts, travel, and entertainment, miscellaneous variable expenses. Fixed expenses, salaries and wages, payroll taxes. Other federal use tax, property taxes, vehicle registration office supplies, postage, printing, insurance, telephone, utilities, dues and subscriptions, accounting, and legal consultants fees. Rent, depreciation, amortization, advertising and promotion, security interest, building maintenance, miscellaneous fixed expenses. Define expenses as variable or fixed according to how much that expense is influenced by sales volume. Variable expenses, while not a direct part of the production process, vary broadly with sales. Fixed expenses aren't related to sales and direct costs, and don't vary with changes in volume and gross profit. Because of these differences, variable expenses are controllable only as far as sales and direct costs are controllable. But management can directly control fixed expenses. Figure 12-1 is a summary of variable and fixed expenses. No matter what volume and direct cost a business may experience, rent remains unchanged over the term of the lease. The following is a list of expenses incurred by most builders. Some expense titles appear more than once, as they're both fixed and variable. You could set up your general ledger in the same order as the list. Some expenses can be both variable and fixed, depending on their definition. For example, payroll taxes on direct labor are variable expenses. Payroll taxes on office salaries are fixed. Figure 12-1, variable and fixed expenses. Then observe the categories precisely when you code expenses. Otherwise, it will be impossible to compare expense categories from month to month. Variable overhead expenses. Payroll taxes, this includes all taxes computed as the employer's share based on direct labor, as opposed to payroll taxes on office salaries. This expense is variable overhead because it's directly influenced by changes in the amount of construction labor required. Taxes, other keep track of variable taxes in detail because they must be listed individually on income tax returns. These taxes include federal excise tax, permits and fees, public utility fees, state fuel tax, and state income tax. Automotive, repairs and maintenance, this includes all repairs, replacement parts, and other maintenance to company vehicles. Automotive, gas and oil, this includes gas and oil used by highway vehicles. Operating supplies, this includes wrapping materials, and any other incidental items used out of the office, but required for doing business rather than for working on a project. Small tools, any tool purchase should be included here, unless the value is high enough to treat as an asset. Treatment is usually determined by the purchase price. Some equipment costs little and isn't worth depreciating, so it's categorized as small tools. This expense can vary with the volume of sales. Equipment rental, this category, should vary according to the special needs of certain projects. Equipment rented or used exclusively on job sites is a direct cost. An example of indirect equipment rental would be leased autos or trucks or shop equipment you use for all jobs. Union welfare, all pension and trust fund payments by an employer are variable because direct labor cost is the basis for measuring the amount due. Direct labor cost varies with business volume. Insurance, certain types of insurance are variable because they relate to specific jobs or labor functions. Some types of insurance vary with the volume of sales and should also be considered as variable. Collection expenses, fees paid to agencies, and other costs of collection are included in this category. These are variable expenses because collection costs usually change with changes in volume. Bad debts, like collection expenses, the amount of bad debts is likely to be affected by volume. Travel and entertainment. Travel and entertainment expenses are limited to those costs that are necessary for the generation of income. They're considered to vary with income. Builders operating over a wide area have meal and lodging expenses as well as car rental costs. These are all travel expenses. Be sure to document entertainment expense and specify its business purpose. Miscellaneous, any other variable operating expense. Fixed overhead expenses. Salaries and wages. This includes payroll for officers, estimators, and clerical employees. The amount is fixed because these expenses aren't necessarily related to sales. Payroll taxes, all payroll taxes on income to company officers and office personnel are fixed. They don't vary with sales or direct costs. Taxes, other. This includes all non-variable taxes such as property taxes and vehicle registration fees. Office supplies, this amount includes all consumable supplies used in your office. The cost of purchasing a pegboard accounting or check writing system would be an office expense. Postage, this account probably won't vary with minor changes in volume. A significant increase in postage expenses would occur if you mailed advertising flyers or took on a lot of new work in a short period. Printing, this includes all letterhead, envelopes, and business cards. Printing expense usually remains fairly steady regardless of sales volume. Insurance, this account should include all insurance on fixed cost items. For example, the cost of insurance on premises, the contents, and health insurance for officers would be fixed expenses. Telephone, this is another controllable expense, which may vary with changes in sales volume. But it's usually defined as fixed because most phone calls are local and are included in the basic monthly charge. With recent changes in rate structures, users can choose between a higher base rate with free toll calls or a lower base rate where calls that were previously free become toll calls. Utilities, this expense doesn't vary with volume. It's generally a cost associated with operating office and warehouse areas. Dues and subscriptions, this includes all memberships, dues, subscriptions, books, and periodicals. It has no direct relationship to sales volume. Accounting and legal, these fees don't vary significantly with income. All accounting and legal fees are administrative costs rather than selling expenses. An increase in these costs would not necessarily be due to an increase in sales. Consultants' fees, this includes all one-time outside consulting fees. There are a variety of types of consultants. Any fee that relates entirely to a job or several jobs is a variable cost and should be included with variable costs under direct costs. Other consulting fees of a general nature belong here. A computer systems analyst, for example. Rent, this includes rent and storage expenses for the general office, shop or warehouse, and any leased buildings or land. Depreciation, this includes all depreciation on trucks and autos, construction equipment, and capitalized office equipment, as well as buildings you own. Amortization. This category is for writing off leasehold improvements, organizational expenses, and any other capitalized asset being amortized. The expense does not relate directly to sales or to the cost of sales. Advertising and promotion. This is usually a limited expense for builders. Any advertising or promotion of your business in general that isn't sales related falls into this category. Include help wanted classified advertising here also. Security. Most builders need to protect their inventories and job sites. The cost of protecting these investments belongs here. Interest. This includes any interest paid on bank loans, notes, and other obligations. Interest on construction loans associated with a particular project would be direct costs. But most loans are used for working capital and don't apply to specific projects. Building maintenance. This includes all current and minor expense associated with maintaining an owned office and shop, such as repairing a leaking roof, doing plumbing repairs, or painting. Leasehold improvements, by comparison, are capitalized. Miscellaneous include here any other expense that doesn't relate to sales volume or the direct cost of those sales. Budgeting expenses. Since expenses are fairly predictable within ranges of business volume, they can be budgeted. The budget is your guide to making the work your company does pay off in acceptable profits. A realistic budget establishes the profit and is the expense standard you plan to observe. The budget is, of course, only a tool. It's the people in your company who control expenses. So think of your budget as your guide to profits. The budgeting process has 3 parts. 1, preparing the budget. 2, analyzing the results. 3, taking action to control expenses. The plan must be realistic or the entire budget is useless. Base your budget on past results and your estimate of reasonable expectations. A budget can be fairly accurate if it allows for price changes and anticipated changes in business volume. Your budget can become a real guide to savings and profits, but only if it meets these requirements. First, it's both realistic and possible to live with. Second, your analysis is frequent and probing enough to spot problems early. Finally, you have to take the action required to correct problems. The goal of a budget isn't to forecast as accurately as possible what expenses will be. Rather, the budget should establish the ideal level of expense and income in a well-controlled operation. Comparing your budget to actual performance will reveal areas where your budget was unrealistic or your company could improve its performance in the future. Analyze over-budget costs to identify areas where money is wasted. Budget analysis. Budget analysis requires accurate books and records and detailed cost information. Because you don't always receive bills at the same time each month, leave some leeway for month-to-month variations. Monitor expenses over several months, and you should begin to find areas where savings are possible. Controlling expenses requires a definite plan. Review each expense category and look for ways to keep the expense level down. You probably already have policies that are aimed at reducing costs. Examples of this would be limiting employee raises with annual reviews to a percentage of their pay, requiring prior approval for certain types of general expenses, careful checking of invoices, and maintaining a log to monitor long-distance telephone calls. Keep a list of the methods and techniques that are effective in minimizing the expenses in your operation. This should include monthly analysis of detailed entries to certain accounts. Figure 12-2 shows an expense analysis form. The components of the office supplies account have been split into the various categories. You see immediately where the cost savings have occurred and where costs have exceeded the budget. Pay special attention to troublesome cost areas. Correct cost overruns before more time goes by and expenses mount. After the analysis of office supplies in Figure 12-2, the builder or his office manager might want to see all requisitions for supplies before. Expense analysis, office supplies. September 20. Figure 12-2 expense analysis, they're ordered. Make sure the goods being purchased are really needed and used. The receptionist or bookkeeper may not be as concerned about budgets as you are. You might decide that you or your office manager should pre-approve office supplies purchases over $50. You might also want to put a time limit on this requirement to prevent abuses to the system. it is obvious from Figure 12-2 that a detailed analysis of all other is needed. Most of the excessive cost falls into this category. This is a common problem in analyzing books and records. There isn't always enough detail on summary reports to be fully revealing, but the last line in this one shows quite a lot. Using the Formula 1, you can see that all other ran more than 11.5 times its budget. Preparing your budget. There are two ways to prepare budgets. Use one method for variable expenses and the other for fixed overhead. Budgets for variable expenses should be prepared as a percentage of income within broad ranges. As your volume changes, your variable expenses will change, but the percentage of each expense category to sales should remain within certain limits. The problem with this approach is that no dollar amounts are included in the budget. There is a tendency to skip over significant variances, blaming them on the level of sales rather than on internal control of expenses. Another approach for variables would be to set budgeted amounts for expenses based on assumptions about the level of sales or labor. This method requires several budgets. You would analyze any variance from the budget for the sales volume closest to actual volume to find the reason for the discrepancy. Prepare your monthly budget for fixed expenses a year in advance. You can estimate most of the expense categories fairly accurately based on the past year's experience. Set optimistic, but also realistic goals. The budget becomes a guideline against which you measure performance each month. Figure 12-3 General Ledger page with subaccounts. A. General Ledger accounts. Efficiency and accuracy are essential in maintaining general ledger accounts. The more accounts your company has, the more time it takes to post and control the ledger. Yet you need enough detail to provide a meaningful breakdown of expenses by category. Two major sections are essential for the general ledger: variable expenses and fixed expenses. Variable expenses can also be called selling expenses. So your financial statement reflects a selling profit, gross sales, direct costs equal to gross profit, selling expense equal to selling profit, overhead equal to net profit. Within variable and fixed cost categories, keep each account and subaccount individually. This doesn't necessarily mean that each account requires a page of its own. Your general ledger would be too awkward for effective control. There are two types of account pages recommended for expense classifications. The first is illustrated in Figure 12-3. This is a page for one account with subaccounts listed to the left. Keep accounts like insurance and taxes, as shown in Figure 12%-3. The second method is shown in Figure 12-4. This is ideal for most expense categories. Only a few pages like this are enough to handle all the variable expense accounts most builders would have. In these examples, all accounts are listed individually but controlled in summary. This saves posting time and works as a control feature. Each line is balanced on that page itself, so no errors slip through. This is important because it's much harder to find and correct mistakes as time passes. The principal difference between figures 12-3 and 12-4 is in the detail provided. Most expense categories don't require the detailed subaccounts shown in Figure 12-3. You can break down some accounts into subaccounts and leave others intact. Remember, the general ledger loses its effectiveness when it includes Figure 12-4 General Ledger page with variable expense categories. Too much detail. Be sure that breakdowns are truly needed. The ledger isn't the proper place to perform detailed analysis, but it is your tool for summarizing your business transactions. Here are the pages I recommend in the general ledger for the accounts in Figure 12-1. Variable expenses, payroll taxes, taxes other, automobile, operating supplies, small tools, equipment rental, union welfare, collection, bad debts, travel, and miscellaneous expenses. Insurance, fixed expenses, salaries and wages, office supplies, postage, printing, telephone, utilities, dues and subscriptions, accounting and legal, and consultants' fees. Payroll taxes and taxes, other, insurance, rent, depreciation, amortization, advertising and promotion, security, interest, building maintenance, and miscellaneous expenses. You should be able to handle all your accounts on a few pages. The collection just recommended has 5 pages of variable expense accounts and 4 pages of fixed overhead expense accounts. Using ratios. Budgeting is only one way to analyze overhead costs. You can sharpen your understanding of company overhead by comparing the overhead costs you have to other figures. Since overhead expenses are divided into 2 broad categories, any combined ratio analysis won't be as meaningful as an analysis of individual items. The 2 ratios that are most significant to a builder in analyzing his overhead are variable overhead expenses to sales, fixed overhead expenses to sales. The comparison of expenses is made to sales because there's less chance for distortion than if you compared expense categories to total costs. If you compare variable expenses to direct costs or fixed expenses to direct costs, any deviation in normal costs would distort the results. Figure 12-5 is a worksheet Johnson Construction used to determine the trend of variable expenses to gross sales. In this example, the variable expenses are based on the accrual accounting method. Compare variable expenses for the month to sales for the Figure 12-5 worksheet for analyzing variable expense ratios. Month and expenses for the last 12 months to sales for the same period. Update the 12-month average each month. For example, as of May 31, the comparisons would be 1. May variable expenses to May earned income. 2. Variable expenses for 12 months ending May 31 to earned income for 12 months ending May 31. These ratios are calculated using this formula: comparison ratio equal to income, expenses. Maintain a separate worksheet to chart the 12-month averages for an entire year. See Figure 12-6. Find the reasons for any unfavorable trend in the ratio. The reports by themselves are useless unless you can reverse the trend. There could be many reasons for relative increases in variable expenses. Price increases could be part of the cause, and your company's charges might not be keeping pace with your costs. There might be other causes as well. For example, equipment expense might be higher now than 5 months ago. This could indicate a lack of organization in assignments or the purchase of unnecessary equipment. Each expense item should be important in your analysis. Compare expenses in different periods. When there's a major difference in expenses, you should know what caused that difference and respond appropriately. You can do a similar analysis for fixed expenses, but the result is less significant than the analysis of variable expenses. Since variables change more than fixed expenses in relation to sales, you measure those in percentage trends. The control of fixed expenses depends entirely on your effectiveness as a manager. A comparison of fixed expenses to sales should show only a steady ratio if volume remained constant, an increase of the ratio with increased sales, or a narrowing of the ratio with decreased sales. Variable expenses to sales ratios 12-month average. Figure 12-6 worksheet for charting 12-month sales and variable expense ratios. But this doesn't tell you much. The best way to control fixed overhead is to make careful monthly comparisons of budget dollar forecasts to the actual results. Identify trends as they develop to rein in a rise in expenses. Comparison of actual expenses to the budget is illustrated in Figure 12%-7. In this example, budget expenses are listed month by month. If you budget expenses for the whole year, rather than for each month, it's easy to blame unfavorable trends on timing differences. That's not enough. Instead, find the cause for current overspending. Document the reasons for variances from the budget. This is a helpful way to remind yourself of the danger of uncontrolled spending. Next year, when you're trying to control expenses and maintain an expense budget, think how helpful it would be to have a monthly summary of this year's expenses along with the remedies you found for overspending. Recording expenses. Expenses are recurring in most cases. That is, they occur month after month in generally set patterns. For example, rent is predictable and payable at about the same time every month. Office supplies, if paid on account, may be payable the same day of each month. Sometimes expenses are recorded before they're paid, as an accrual. At the end of the accounting month, expenses incurred but not paid are accrued by recording a liability. So the profit and loss statement for that month shows the expense in the month that the liability exists. The entry to accrue an expense would be, when the account is paid, the entry would be, accounts payable for this expense item is returned to zero. The effect is the same as though a cash payment had been made in the first place. This kind of entry should be made at the close of the first month in which the expense is known and the value has been received. You will have liabilities like this every month. Because current liabilities aren't always billed and paid the same month value is received. Another way to record expenses in a period other than when paid is to set up a prepaid asset. An example of a prepaid asset would be an annual insurance premium. The policy is paid by a single payment at the beginning of the policy year. The balance must be deferred on your books until it's earned. For example, a July payment of $120 would be set up as a prepaid asset and deferred through each month to the following June. This is illustrated in Figure 12-8, which also shows the treatment for a single payment covering 36 months. The entry to record a prepayment such as insurance is Figure 12-7 Fixed Expense Budget Analysis. The entry to record each month's charges is this kind of accounting lets your books carry the proper amount of expense in each month. The examples given involve only small amounts, but prepaid insurance plus other types of expense can add up to a significant amount. Set up payments for large expenses which apply over a defined period and recognize a portion each month. Still, another way to treat expenses is to capitalize them as deferred assets. Prepaid and deferred assets are often thought of as the same thing. But there is a difference. Prepaid assets defer recognition of an expense until value is received for that expense. A deferred asset might be a one-time charge. An example of this might be organizational expense. The cost of organizing a business can be high. The cost should not be charged against the first year of operations. Instead, you should set up in an asset account organizational expenses and write off the cost over a period of years. This process of spreading costs over a period of years is called amortization. It's handled like depreciation. You charge an amount to an expense category each month and reduce the asset by the same amount. Another distinction between the two types of assets is that prepaid assets could be considered current assets, while deferred charges usually aren't current. That is, they aren't likely to go to zero in the next 12 months. To avoid confusion, both accounts are normally included in the balance sheet classification as other assets.